Hello everyone, this is Alex Suslov, Head of Capital Markets at A&D Mortgage, with our AD Weekly Digest. As always, we're here to shed more light on economic events, mortgages and market forecasts. I hope everyone had a nice long weekend after exciting CPI news. For me, it felt like a first warm day in February when everyone took coats off after a long winter season. However, this does not constitute the winter is over yet. Last Thursday, CPI numbers were shy of expectations, which has sparked rally on the market and raised hopes in dovish Fed hikes in December and going forward. Conventional mortgages had a huge drop in spreads of 25 basis points at the end of the week. And it was largest intraday improvement in the past 2 years that we saw. As a result, we had a 0.5% rate improvement for agency loans. With this being said, turning it to Billy at this moment to get more insight on last week's actions and investor expectations. Billy, how are you?
Alex, I'm doing okay, Alex. I lost a fight with my dermatologist, evidenced by the bandage on my nose, but that was Wednesday and it was forgotten as soon as CPI came out Thursday morning. So the week before last, the Fed raised Fed funds 75 basis points to 4%. We learned once again that the jobs markets were stronger than expected, and yet neither of those had any impact on the Treasury markets. The markets remained very weak. They remained near their high yields, which were printed on October 21st. Only the 2-year and the 3-year had made new high yields. But then Thursday morning, we got the latest CPI report. And for those of you who don't read my updates, I had been saying that the first better than expected inflation report was likely going to see an overreaction by the Treasuries. In hindsight, that was an understatement. Headline, core, and the year-over-year CPI numbers all beat expectations by 0.2%. And while those numbers aren't necessarily proof that inflation has peaked, the year-over-year number has now declined for 4 consecutive months. And I think that means something. Since December of 2020, when inflation began to rise from just 1.2%, there were only 2 months when the year-over-year number came in lower than it had the month before. And then the trend immediately resumed. We may not know if inflation has peaked, but the 2-year rise was uninterrupted, and one can't help but wonder if the decline might not be uninterrupted as well, in which case these 4 consecutive months do mean something. It took only about 5 minutes for the 5-year to rally 35 basis points, trading back to where it was on October 5th. I think we can now assume that the December rate hike is not going to be 75 beeps and maybe not even 50. The reversals are very impressive technically. That's undeniable. And while I'm not sure, Thursday may have been the best day for Treasury since the day after the stock market crash in 1987. Clearly, to me, the worst of the cycle up in yields from 2020 is behind us. I think we can also expect to see the spreads of mortgages continue to work their way back towards normalcy, which is good for the mortgage markets. At the same time, I also think that that the yield curve may have seen the worst of its inversion, and that could mitigate any benefits of mortgage spreads tightening. So it may not all be good news, but I know one thing for sure, and that is this edition of the AD Digest is finishing up on the brightest note it ever has. Back to you, Alex.
Thank you, Billy. A lot of food for thought. Next week we'll be focusing on jobless claims, and on December 14th we're waiting for next FOMC decision. Make sure to follow us on YouTube channel, like this video and subscribe to Billy's daily market newsletters to stay on top of the capital market events. Thanks everyone, it was Alex Suslov, Head of Capital Markets at AD Mortgage. Stay tuned.